Hi, I'm Brad Johnson. I've invested in GP stakes funds. I've done it for myself. I've done it on behalf of clients. I've also invested over 200 million in alternative assets. This is one of our favorite niches. And so let's teach you a little bit about GP stakes investing. All right, at a basic level here, you, the minority partner, the GP stakes investor in green here in this box, are going to be making a investment into a general partner, a private equity firm. This could be growth equity. This could be venture capital. This could be real estate, infrastructure, private credit. Most of the time, it's private equity. The majority of GP stakes investments are predominantly general partnerships of large private equity firms. We're talking over 100 billion in assets over management. These aren't startups. These are well-established general partnerships of large private equity firms. And so you, the minority partner, are writing them a check. And this GP stakes fund is going to be giving that general partner some other strategic help, namely introductions to large limited partners so the GP can grow their assets under management and continue to grow. And so both sides benefit from that. And then in return for that money and help, the general partner is going to give the minority partner, us in this case, the investor, they're going to give us a share, a pro rata share of their management fees across all their funds, a percentage of the promoted profits. This is the carried interest that a private equity gets. The majority of their wealth is generated from that carried interest over time. But frankly, the management fees are quite good too when you're managing over $100 billion, of course, at 1% to 2% per fund. And the private equity firm is also going to give the minority partner, the GP stakes investor, a share of the balance sheet investments. And that just means the general partner's investments in the various private equity funds. So normally when you launch a private equity firm, you have to make a co-investment alongside your limited partners. And maybe that's 1% to 5% of the fund that you're raising to show your skin in the game, to show your commitment to the strategy. So those checks get larger and larger as a private equity firm grows. And because you're investing in the actual entity, the general partnership, the minority partner gets a share of those balance sheet investments as well, which is wonderful. And this slide just hammers that point home. Once again, three ways to generate cash here: management fees, carried interest, and balance sheet returns. And it's just to make the point, hammer the point home, is that you are going to be sitting on the same side as the general partner. You effectively now are owner of this general partnership, this private equity firm that is out there with the best and brightest people looking for great deals, improving those deals, selling them in 5 to 10 years. All those profits are getting pulled together into the entity that owns the private equity company, and you as a minority partner get a piece of that. This is an amazing deal. Think of all the people that you've heard of that have generated their wealth through private equity. Tremendous amount of wealth has been created over the last 20, 30 years. The partners of these private equity firms have generated unbelievable wealth the last 30 years. All right, so how do those three buckets, how do those revenue streams come to you? The management fees, carried interest, and balance sheet returns are all going to come in the form of distributions. Sometimes they're monthly, sometimes it's quarterly, but they're going to come in terms of distributions paid to you relatively quickly. Unlike a traditional private equity firm, you're making the investment and you might not see a distribution for 5, 7 years if it's a 10-year fund, because they're buying a portfolio of companies, they're improving those companies, and then ultimately they're selling those companies. And so you're only getting paid when they sell. You're not getting paid regular distributions along the way with a traditional private equity fund. Whereas a GP stakes investment, because you are participating as the GP, you're getting a piece of their management fees, you're getting a slice of the promote from all of their funds, not just one fund in particular. You get all of their funds over their entire existence as a general partnership. They might have 10 funds and you're participating in each of those. And so that smooths out the number of distributions that tend to come, because at any given moment, one fund is paying out some distribution. And then, of course, the balance sheet returns is very similar to the promote that we're talking about. It's just the private equity's balance sheet piece of that fund that they actually contributed. And that money gets a great return typically in private equity. So those three components are making up the distributions that come in terms of the cash flow, which is why this is such an attractive high cash flow investment typically, versus a private equity fund. Once again, that's all going to be back end weighted. This is a bit more de-risked because you're getting a lot of your money, a lot of your invested capital back pretty quickly from that high cash flow. And then there's this fourth component to GP stakes investing, that has to do with the enterprise value of that general partnership. They can go get a dividend recap, which just is a fancy way of saying they're going to refinance their firm from a bank, pull out some money, perhaps pay off some debt. Maybe they want to pay off their minority interest GP stake investor. Oftentimes, you don't have to get paid off, but maybe the investor wants that dividend recap at that time. And so that fourth component is really what I call the enterprise value bucket. And that's the long term appreciation, the value of that company, right? The bigger funds that they raise, the more funds that they raise, the different asset classes they expand into. Perhaps they add a private credit strategy, perhaps they add real estate. That enterprise value is just like appreciation of a stock. So a minority stakes GP investor gets the benefit from that increased enterprise value over time as those assets continue to grow. And so those four components obviously make up your total return. And oftentimes in these funds, those have been extremely attractive over long-term holds. 20 plus IRRs historically for many GP stakes funds has been fairly common. So why in the world would a general partnership, a private equity firm that owns the golden goose, why would they sell off a piece of this? Why would they sell off this wealth generating machine that they own? Well, they are a bit of a victim of their own success. The larger and larger these firms get, they have to write larger and larger co-investment checks, which we've talked about. Writing a 5%, even a 2 or 1% check on a $5 billion fund is going to add up pretty quickly. If you are raising a new fund every 2 years, some of these firms are raising a new fund every year. And so that gets difficult for especially the younger associates, vice presidents of these firms. That gets difficult for them to pony up every time there's a new fund coming in. They have to write a check often to become a partner of the firm. And maybe there's somebody who is retiring and is exiting the firm. And because the general partnership is private, it's not publicly traded, it's very difficult for the younger professionals to go ahead and pay out the older leaving professionals. So succession planning is big. This is also important for growth. Some firms, especially in the middle market, they really want more money to go out and hire new teams to pursue new strategies. They want to hire a fundraising team so they can raise more capital. You can fly all over the place, talk to investment firms, RIAs, endowments, foundations, pension funds. That takes capital to build that team. And so it's a selfish decision for them to take this outside capital, this minority interest through GP stakes investing. And it's become very common in the industry, once again, because these firms have grown so large and have become victims of their own success in that regard. And then I touched on the strategic advice. Sometimes that comes in the form of helping them with new hires, consultants, operating partners, but oftentimes, really the main value, I think, for the middle market private equity firms, taking a minority investment from such a large GP stakes investor is that GP stakes investor has a ton of relationships, especially in the limited partner world, because these GP stakes investment firms are quite large themselves. And so if you are making a minority investment into one of these general partnerships, you have a great aligned interest to help them out. You want to see them grow. You want them to keep raising larger and larger funds that are more and more successful, because once again, those asset management fees continue to grow, those promoted profits grow, and you're getting a piece of that. So why wouldn't you help them and make more introductions now that you have a vested interest being a part owner, minority owner of that general partnership? And so that's a big component of this too. They're not just taking this capital from anybody. It's not commodity capital that they're looking for. This capital is strategic in nature because it can help them grow, and the pie gets bigger. So everybody ends up making more money, even though the partners are selling a bit of their firm. And just at a high level before we wrap up, why is GP stakes investing interesting right now? It's because private assets, and namely alternative assets, the private markets are growing tremendously, and they're projected to continue to grow over the next 10 years, going from 13 trillion up to 21 trillion over the next, call it 5 years, 4 or 5 years, which is a ton of money that's in play. That's a giant tailwind, which benefits all of the private equity companies that can go out there and get their share of those assets under management. And here's just a final point to hit that home. Right now, private assets are actually a fraction of the total global wealth. And so if you think about how well private equity and private assets have performed relative to their public counterparts, it's not a stretch to see where this is going. The trend is clearly increasing for private assets. And so, given that the private wealth market, individuals, and even family offices are not over allocated to private assets, they're woefully under allocated to private assets. That is a pretty clear sign that this is a growth industry and should be for some time. And so, hopefully, that was a pretty good starting point for GP stakes investing. It's a unique asset class that has very attractive risk reward components to it because of that high income from the management fees, which are contractual in nature. It's really hard to see these firms, these mega $100 billion, even $5 billion asset management firms. It's hard to see them blowing up, especially if you're diversifying a portfolio over 15 to 20 of these private equity firms. And yet you still have that tremendous upside capability from the continued growth and wealth creation that these firms have historically done and should continue to for some time. So there it is, GP stakes investing. If you like some of the research that Evergreen Capital has prepared on GP stakes investing, you can look down below in the description and shoot us an email. We're happy to send it to you. All right. Thank you.